Hello and welcome. Let me start by introducing myself. My name is Casey Clark, and I am a vice president and dean in WGU School of Business. And I have two very smart gentlemen here with me today that are going to chime in on this conversation. So, Jim, you want to take a second and introduce yourself?
Absolutely. Thanks, Casey. Jim Franklin, Associate Dean here at the WGU School of Business for Accounting, Finance, and Supply Chain Operations Management.
Thanks,
And
Jim.
my
Ron?
name's Ron Primoroso, and I'm an instructor here in the undergraduate accounting program at Western Governors University, which I might mention has the largest undergraduate accounting program in the nation these days.
Yes, and we are very proud of that. And I was joking before we started that there's probably not a question financially that these two guys can't handle. So we'll jump right in with some questions. It is a really interesting time that we're living in, and I think for a lot of people, the stock market is just a scary thing when they hear it, and all the parts that go into it. So let's start there. And Jim, could you walk us through what drives day-to-day market fluctuations and how that should affect an investor?
Sure, absolutely, Casey. There's a number of different factors that can influence stock prices. One of them is what you'd expect, right? Company performance. How's the company doing? What are its earnings? What are the overall results? What's its potential for growth looking forward into the future? And then it's not the stock market's not immune from what's going on in the world, right? So you have to look at a whole bunch of economic indicators as well. So, right, that's going to be GDP growth. How much is the country growing? How much are other economies growing for export opportunities? You look at inflation, you look at current unemployment rates, and a whole host of just factors within the country and in the economy itself. And then one of the other big ones that affects it is government policy. So that would include spending, changes in taxes, regulation, and then whatever a government's monetary policy is in terms of decisions that the Federal Reserve is making about interest rates and such. And I think one of the last ones is that we're kind of seeing some of this in the world right now is just news events, things going on in the world, different speculation, different things that people are doing that can help to drive volatility, not necessarily the long-term value, but they can affect what happens day to day.
Yeah, you said a word that made my heart skip a little bit when I hear it in the news, and that's volatility or market correction, those words that you hear. And Rod, I'd love to turn to you on this. Like, how should investors interpret those? Is it always a bad thing when you hear those?
Well, I think fortunately I'm old enough, as some of us are, to look backwards and say, okay, we've been through the internet bubble right around 2000, year 2000, when all the internet stocks were going public and going crazy in their price, and then the market crashed, right? We all remember the banking crisis, right, from 2007 to 2010, which actually kept interest rates low, right, until about 2018, 2020, right? And I think it all depends on an individual's perspective and their financial needs, right? At the time that there's volatility. So, of course, if you're near retirement and you're starting to make your minimum distributions from your retirement plans required by the tax laws, right? Volatility could perhaps hurt. Okay. But if you're younger, and I've always subscribed to this from my own personal point of view, is you kind of just ride out these volatility sessions and just look at the long range, long term performance of the stock market, which is around a 7 to 8% compounded growth rate, right, over the last 100 years or so. So, it's just a matter of your personal perspective. Where are you? What are your monetary needs at the moment when there's volatility? And I have to say, feel bad if people are exceptionally withdrawing at times when the market gets volatile because they get scared of the performance of the market. And we've seen that in the last 30 days, right? The market was down 20% about a month ago, right? Within a few days due to a variety of factors, and now it's recovered, right, within 30 days. Of course, we can't predict what the future is going to be like. So I think it really depends on where you are, Casey, personally and professionally, and of course, financially, on what your perspective should be when the market becomes so volatile.
Yeah, I heard someone once told me, you only get hurt on a roller coaster if you jump off, right? Like, and so if you jump off at the wrong time, you can really get hurt there. One thing that I always, I'll see news stories where it says, is it a bull market or is it a bear market that's happening right now? So maybe Jim, could you uh, tell us what bull and bear means? Like what for the average investor, like what should they think about when they hear those terms or when the market does that?
Yeah, and typically when you think of a bull market, the definition the market tends to use is one in which you've seen about a 20% or more increase from a recent low in terms of and from a measured time period. And basically what that means is your portfolio is growing, your stocks are rising in value. So that's obviously a huge positive. You're getting a higher return for the investment that you've made. And I think those are just some of the key components of that bull market. Whereas a bear market is exact opposite, right? Things have gone down by about 20% from whatever the recent high was. And then at that point, they'll say that a lot of times that's due to some economic uh, factors that have caused a downturn. You've got negative investor sentiment. Folks are thinking, hey, the future's not looking that great, or at least the near future. And again, some of this, especially on the downside, the bear market can happen because you've just got sentiment at the time, which sometimes can drive things and drive some short-term thinking, right? And so people will go ahead and trade on that. And then you have people who try to time the market within that too, right? I'm going to sell now. This is the time, and then I'll jump back in. Very few people that I've met can go ahead and predict when that bottom hits and when we're going to start to come back up again, and do that in a way that they're not missing out. And so I agree completely with what Ron said earlier. And one of the important things to remember is if you're out of the market most of the time in that bear market time frame, you're going to miss the correction and the recovery. You won't hit it exactly. Some of the biggest days in the market have been when things are down, and then they come back up, and we've seen that just in the last couple of weeks. So I think it's that the push and pull that goes back and forth between there in volatile times. It's really hard to predict it, and so sometimes, as we've all said, you have to kind of stay in it, stay on the roller coaster, as you described it, Casey.
Yeah, Ron, I wanted to go back to you on this because you talked about that, average rate of return. And I thought Jim brought out a good point there is like, it's not every single year that you get an 8% return, right? Can you talk a little bit more about that and how it fluctuates over time?
Well, as I think also Jim explained very, very correctly, is that return you have to look at long range returns rather than getting bottled down or bogged down with, well, in the last year it dropped 3%. We've had periods, right, where the market went down substantially. I didn't mention others like 9/11, right? That week or two after that, and also there was a very large drop in the stock market. So for younger people like our Jennifer here, right, who's our host for this meeting, right? I've been telling Jennifer for weeks, when you're young, that is the time to invest. Think long term and take advantage, Casey, of that long term return in the market. Okay. And I remember in my history, I think during the banking crisis, I was in the process of a countrywide move to teach somewhere, and the market crashed right in 2007 8, and I didn't look at my investments for a year, Casey. I didn't even look. Okay. Again, because being the experience of many any declines in the market, substantial declines like Jim mentioned, I just knew in the long term that, for me, I was looking 5 or 10 or 15 years again down the line. Why sit there and dwell, right, on a market that's down so much at that point, knowing it's going to recover? And actually, at that time, and I'm not giving financial advice to those listening to this recording, but I actually put in more, as much as I could, into my retirement accounts at that time, based on whatever the law was in effect, the tax laws at that time. So I hope that advice is helpful to those of you listening to this call.
Yeah, Ron, let me follow up on that part about advice there. And we aren't get this is not financial advice, and we do recommend that you work with licensed professionals. Why is it important that people work with licensed professionals, Ron?
Well, even I have worked with licensed professionals, okay, because I don't have my pulse on the stock market on a daily basis. I don't have my pulse on the bond market on a daily basis. So, if you're able to, it's very important to consider hiring a licensed, right, qualified, check their background professional, right, who has a good history, right, not two ratings on the social media, right, but quite a few ratings of people that have said that consistently they seem to be very good advisors on their particular situations in managing their retirement funds. Okay, so even though I have a finance and accounting background, I still don't believe I am qualified enough to do all of that on a daily basis. I can't keep my pulse on the market. I don't know what's coming in the market. Okay, I have a good idea, but that's what you could, if you have the ability to do that, that's what you pay these professionals for, Casey.
I appreciate that, and it's good to know that professionals use professionals, right? That brings a level of confidence for me. Jim, I'd like to turn to, we hear a lot in the news right now around inflation and interest rates, and how does that impact someone's investment? Like, does an interest rate tie right to my 401k? Does inflation impact my savings? Can you give us more on that?
Sure, absolutely. First of all, I want to echo my sentiment in terms of using professionals to help with your management of your portfolio. I think they can offer a great deal of insight, and it's really, really important to do that. So, one of the other things that I think professionals can do is help you to understand what your ability to take on risk is, and I think that that's a really important point. That risk quite frankly, ties right into your question, Casey, talking about interest rates, right? In terms of looking at what you think short term and long term interest rates are going to look like, because to a very large degree, that will affect your portfolio in a number of different ways. Interest rates will affect stocks. They tend to go ahead and inhibit some growth potentially as rates rise, especially on some of your faster growing growth stocks, like the ones that we see in the tech world, the companies that we hear about all the time. I think it also can affect how you want to style your portfolio. If you're getting a higher rate of interest, you may look and say, especially if you're closer to retirement, potentially saying, well, you know what, I'm going to have a higher percentage of bonds in my portfolio. And I can have an opportunity there to ladder them with different maturities, some being shorter and then some midterm and some a little bit longer. And that helps me to go ahead and to manage as interest rates change because I have an opportunity then to renew some of the ones that I have shorter to take advantage of that higher interest rate that may come in another year or two. I also think it opens up opportunities for things like tips, where you have treasury, inflation protected securities that you can buy into that help with inflation and with higher interest rates to be able to sort of manage that. Those particular securities will increase the return to you if there's more inflation. And so they offer some opportunities there to protect yourself. And the last thing that I'm a big fan of is judicious investing in real estate, which helps to in many instances help with inflation and with factors as costs increase because inflation tends to benefit some of those real estate investments and things that you've got in there as rents rise, right, to establish projects, either in apartments or commercial building.
Yeah, that's helpful. Thank you. Ron, I wanted to go back to a little bit what you're talking about with like how your age should impact how you think about retirement and savings. I've seen a lot lately about Gen Z being more risk adverse than prior generations and investing different, a little differently. Is that wise? Like, how should your age impact how you invest?
Well, there's a lot of considerations there, of course, not only age, but family, right? What is the amount of money you're making? Is it a dual situation with wife and husband or partners, right? Both bringing in money at the same time. And also these days, the consideration has to be, it's very hard for us to predict what the tax rates are going to be, Casey, right? Once you retire. Okay. So even planning ahead and putting away money into your retirement plans, depending on who you're working for, if they have a matching situation, Casey, that's a wonderful opportunity starting when you're young. right, to put away money for retirement. Your employer's matching it or has some degree of match to put it in there at the same time. Okay. And there are also tax ways, right, where maybe if your income is low today, you'd want to put that into a retirement account, have it taxed immediately so that when you take it out at retirement age, right, you don't have to pay tax. Again, with the understanding that maybe in the future we don't know what tax rates are going to be, right? They can go up and they can go down. So I think for younger people or younger portions of our audience listening to this conversation and this discussion, I really believe it's very smart. And again, with the uncertainty, perhaps to some degree of Social Security being able to pay to a certain extent, maybe in the future, right? Our government's always talking about that. But to put away as much money as possible that you can afford to put away as you're young, right, into retirement accounts is a very smart strategy. Again, parlaying Casey on my overall return comment, right? The market is averaging 7 to 10% on a long range basis for a return. So that's a very smart thing to do, especially in a younger age. So for the Gen Z, I think there's some nervousness there perhaps about the what's going on in the world today, what's happening here and there, right? There's maybe a little bit more nervousness than there was when I was young as far as looking to the future and what's going to happen, especially
Yeah.
with the investment in stocks.
Yeah, no two people are the same, right? So
Yes.
even depending on what generation you're part of, you could be risk adverse and young, you could be risk adverse and not young. I didn't appreciate you not including me in the young list with Jennifer, but we're gonna let that go, Ron. I'll talk to you about that
I
later.
know, yeah. That's not a good career move probably at
Yeah.
this point.
Um, I would like one last question on these, and then I have a quick lightning round for the two of you. Jim, I hear this word called Roth all the time. Like there's different types of investing, like a Roth investment or a traditional, an IRA, a 401k, a 403b, a simple plan. Like, could you just demystify some of those terms and tell us what the heck they mean?
And Jim,
Sure.
yeah, that's really important, Jim. I was kind of alluding to that, so I would love for you to go through that for us.
Yeah, absolutely. Okay, so let's start off with a 401k, right? So that's something actually this was my son's first day at work. So he's doing his employment elections right now, and he's had an opportunity to decide what he wants to do. And with a lot of employers, what happens is that you have an opportunity to set aside some money from your paycheck, in effect, take it out on a pre-tax basis, so before it gets taxed, and make a contribution into this 401k, this retirement fund, in effect. And what happens is you can choose and elect which, with most employers, you can elect which funds you want to go ahead and put it in, how you want to allocate the total pie of money that you have. Some might be into stocks, some might be in bonds. They'll have different stock funds you can invest in. Some are going to be composed of different companies. You can kind of choose which ones you want to do. And so you can go ahead and do that on a pre-tax basis. And a lot of employers will offer you an opportunity where they'll be matching what you put in, sometimes up to generally in the neighborhood of about 4 to 6%, depending where you work. And what happens is that's effectively free money, right? So if you put in $1,000 and your employer says, "Hey, I'm going to give you another 1,000 towards your retirement," so you always want to take advantage of free money, right? I don't think you have to be a financial expert to realize that's a really good deal. Anytime I can get something for nothing, that's good. So that's basically your 401k. And then with Roth, you have an opportunity to make a contribution into a Roth IRA policy. And what that does is that is after tax money. So that's money that you pay taxes on already. And then you put it into a special fund separate from your 401k, and you can grow that. And the nice thing about that one is it grows tax free. Like you're basically growing money without having to pay any taxes on it. And then what happens is you can withdraw it tax free. And so there's some real opportunities there to grow something that you're going to keep all of when it ultimately comes out to you in a distribution when you choose to take it. Now, in talking about those distributions, you have to be careful because you can't be pulling out money early from a lot of these retirement funds until you reach 59 and a half, generally under current law. So like a 401k or an IRA that you set up, you would have to wait, or you'd have to pay a penalty to take it out. Now, there are some provisions where you can borrow the money, but that gets into the complexity beyond the scope of this webinar. That's where that financial professional that we've been talking about can help you through things. And so more on that though from them. So anyway, that's just a really brief overview of the things that you can do with different investment options.
It's so funny how terminology can make stuff a little intimidating, but just looking up what the word means sometimes like will demystify that to you. Like Roth, just the fact that it's after tax versus pre-tax. Like it's the concepts are not that simple, just the language can be intimidating. So I think that's a good takeaway. Okay, two last questions here, lightning round for both of you. What is one myth that you would love to debunk about retirement savings in the market?
I think for me, it would be that you can time the market. Some people
Yeah.
think they can. There's a lot of day traders and folks out there that think that they have the super secret to figuring it out. And everybody I know, and I know some pretty smart people, no one's figured out exactly when to time that and to do that. And I think it's probably not best to try to do that.
And I think for me, that would be panic selling. You might sleep well that night because you've sold, right, and liquidated. But, you know, do not panic sell.
Yeah,
Do
that's
not.
good.
Okay. If you're reading all the newspapers and accounts on all that about, market going down, et cetera, and, do not let that influence you. Go to the financial advisor and they will give you the best advice they can under the circumstances.
It's interesting. Some of this is like be in it for the long term, make consistent decisions, don't overreact, right? Those kind of lessons that you can, it's easy to get a little worked up when, when you hear everything that's going on. So, okay, last question here. Just is like, what is one piece of advice you would give to someone who's really nervous about today's market and their retirement?
Ron, do you want to start with that one?
Again, it depends on your age, it depends on many factors. Okay. But I think I mentioned earlier when the market went down substantially in 2007 through 10, I didn't look at my investments in retirement funds for a year. I did not look. Okay. I focused on my family, I focused on my life, I focused on my priorities, and I wasn't going to be looking, and I didn't for more than a year. I think it was, and maybe it was even 2 years. I didn't even look. Okay, so I think
That is the
that's
most
important.
healthy accounting person's way of dealing with that I've ever heard of. I very rarely could meet an accountant that didn't look at their account multiple times. So I love that advice. That's great. How about you, Jim?
So yeah, I think Ron's got some great advice there. I think it's like we've talked about already, right? Working with a professional manager, deciding what level of risk you feel comfortable with, and everyone's going to be in a different situation there. So I think you have to look at that, look at the time you have to retirement, and that should help to influence what you've got. And then I'd also say whether you go up or whether you go down, personally, I would keep an eye on my portfolio to look at my allocations to see if I've gotten a little bit out of whack from how my investment strategy matches to my risk profile and what I'm looking for in terms of risk, because I want to make sure that I'm in the right space in terms of how that goes. So I would do that, and I think you just think about it a little bit, and then you can set it and forget it, kind of like Ron's saying, right? Then you have to come back and check it for a while. Get away from checking daily because there's going to be volatility no matter what. So don't go that route, and I think
Yeah.
you'll be a lot happier.
And I want to add what Jim said. You always need to be looking at your portfolio mix and risk tolerance and those things as you progress in your life. You need to, with a financial advisor helping you, when you're younger, perhaps more risk is appropriate if that's what you believe it works for you. But as you get older, perhaps there's to be some shifting with the help of a financial advisor to less risky portfolio, for example.
Really great advice. Don't do this alone. Be consistent. Ride the wave. and make sure you understand what you're invested in. I think these are great takeaways for us. So, Jim, Ron, thank you so much for your time. For everyone listening, thank you for listening. These two are available to help with great stories that you might want to pitch from WGU School of Business. So, thank you for your time.
Thank you, Casey.
Thank you, Casey.